Imagine you're enjoying a sunny afternoon at a picnic, balancing a basket overflowing with colorful eggs. Suddenly, your foot catches a hidden rock, sending the basket tumbling. In a flash, all the eggs crack, leaving you with a broken picnic and a mess to clean up. This unfortunate scene might seem unrelated to your finances, but it perfectly illustrates the importance of diversification in investing. Just like you wouldn't want all your eggs in one basket, you wouldn't want all your financial hopes and dreams tied to a single investment. This video dives into the world of diversification, explaining why it's crucial for building a secure financial future. We'll break down different types of investments in easy-to-understand terms, explore ways to create a balanced portfolio, and equip you with the knowledge to navigate your financial journey with confidence. So, whether you're a seasoned investor or just starting out, join us as we explore the art of not putting all your eggs in one basket. Let's unpack what diversification means before we delve deeper. What is diversification? Diversification simply means spreading your investments across different types of assets. Think of it like creating a safety net. If one type of investment goes down, others may go up, helping to protect your overall financial well-being. Imagine Sarah, a young professional saving for a house. She could invest all her money in a single company she believes will perform well. However, if that company experiences unexpected challenges, Sarah could lose a significant portion of her savings. By diversifying, Sarah could invest some money in stocks of different companies, some bonds, and maybe even a bit of real estate. This way, even if one investment performs poorly, the others can help balance it out. Now that we understand the basics of diversification, let's dive deeper into why it's such a powerful tool for investors. Why is diversification important? There are three main reasons why diversification is crucial. First, reduces risk. The financial world is unpredictable. Companies, industries, and even entire economies can experience unexpected downturns. By diversifying, you're not putting all your eggs in one basket and becoming overly exposed to any single risk factor. Second, achieves goals. Different investments offer different levels of potential returns and risks. By strategically spreading your money across different types of investments, you can create a portfolio that balances risk and reward, aligning with your long-term goals. Third, promotes calmness. When heavily invested in a single asset that suddenly drops, it can be stressful. Diversification helps reduce the impact of any single investment's performance on your overall portfolio, leading to a calmer and more rational approach to managing your finances. Now, let's explore different types of baskets you can use to diversify your portfolio. Different asset classes for diversification. There are 5 different types of asset classes for diversification. First, stocks. Owning a piece of individual companies. They offer potentially high returns, but come with higher risk due to fluctuations in the company's performance and the overall market. Second, bonds. Like loans you make to governments or companies. They offer regular interest payments and are generally considered less risky than stocks, but offer lower potential returns. Third, cash and cash equivalents. Savings accounts, money market funds, and certificates of deposit. They offer low risk and immediate access to your money, but also tend to offer lower returns compared to other options. Fourth, real estate. Owning property directly or through real estate investment trusts. Real estate can provide rental income and potential appreciation in value, but it also comes with specific risks, like managing properties and dealing with vacancy periods. Fifth, commodities. Physical assets like gold, oil, or agricultural products. They can offer diversification benefits and protection against inflation, but also come with their own risks associated with price fluctuations and market volatility. Ready to put your diversification knowledge into action? Let's dive into building a personalized portfolio that helps you reach your financial goals. Building a diversified portfolio. So, how do you actually create this diverse basket of investments? Here are 3 simple steps to approach. Step 1. Know your goals. What are you saving for? Retirement, a down payment, or long-term wealth building? This will help you decide how long you can invest, which is called investment horizon. It means the period from investment to selling and cashing out and how much risk you're comfortable with. Step 2. Understand your risk tolerance. How comfortable are you with potential losses? Younger investors with a longer investment horizon can generally tolerate more risk, while those nearing retirement may prefer lower-risk investments. Here's why. Longer time to recover. Younger investors typically have several decades until they need their investment funds. This means they have more time to ride out market fluctuations and potentially recover from any losses incurred in higher-risk investments. Potential for higher returns. Higher-risk investments such as stocks historically offer greater long-term returns compared to lower-risk options like bonds. While not guaranteed, these higher returns can significantly impact wealth accumulation, particularly over longer time periods. Younger investors can afford to take on more risk in pursuit of these potentially higher returns, as they have time to ride out market volatility and benefit from compounding growth. Lower financial dependency. Younger individuals are likely in earlier stages of their careers and may have fewer immediate financial responsibilities compared to those nearing retirement. This allows them to absorb potential losses without jeopardizing their current financial well-being as significantly. Step 3. Choose your investments. Once you understand your goals and risk tolerance, you can start researching and choosing specific investments within each asset class. This can involve individual stocks and bonds, but remember, it requires significant research and knowledge. Thinking outside the traditional stock and bond box? Let's explore some alternative diversification strategies to expand your investment choices. Alternative diversification strategies. Many investors, especially beginners, may find managed investment options more suitable for building a diversified portfolio. There are 3 options that offer a way to achieve diversification without the need to research and select individual investments. First, mutual funds. Imagine a picnic basket overflowing with colorful fruits and vegetables instead of just eggs. That's the basic idea behind a mutual fund. It collects money from many people and uses it to buy a variety of investments like stocks and bonds. Mutual funds are like pre-made investment baskets with different goals. Some focus on growth, aiming for higher returns over time. Others prioritize income, generating regular payments. And balanced funds offer a mix of both. Second, exchange-traded funds, so-called ETF. ETF is similar to mutual funds. They are also baskets of investments, but they trade like individual stocks on a stock exchange throughout the day. This means you can buy or sell them whenever the market is open, just like you would with any other stock. This flexibility is akin to having a grocery basket you can fill or empty whenever you please, offering more control than a prepackaged picnic basket. On the other hand, mutual funds are typically bought or sold at the end of the trading day at their net asset value. While both ETFs and mutual funds offer diversification by pooling together various assets, there are notable differences. ETFs often have lower expense ratios compared to mutual funds, and they may offer tax advantages due to their structure. Additionally, ETFs provide transparency, as their holdings are disclosed daily, whereas mutual funds typically disclose their holdings less frequently. Third, target date funds. These are investment funds designed to simplify retirement planning. They are like all-in-one picnic baskets that automatically adjust their contents as you get closer to your target date, typically retirement. Imagine a picnic basket that starts with mostly adventurous snacks like trail mix and protein bars for a young investor, then gradually transitions to more relaxing picnic fare like cheese and crackers as they approach retirement. As you near your target date, the fund becomes more conservative, reducing your exposure to riskier assets like stocks. Picking the perfect basket. Tips for choosing managed funds. So, you've decided to explore managed funds? Fantastic. Now, let me tell you how to choose managed funds. Here are 3 key things to consider when picking your perfect picnic basket. First, goal matching. Like picking snacks for your picnic, choosing the right investment fund involves aligning it with your financial goals. When considering your options, it's important to understand the difference between growth and income funds. Growth funds. These funds primarily focus on increasing the value of your investment over the long term. They typically invest in companies with high growth potential, such as emerging technologies or industries. The goal is to generate capital appreciation, which means your investment grows in value over time. Growth funds may be suitable for investors with long-term goals, such as saving for retirement or building wealth over time. Income funds. On the other hand, Income funds prioritize generating regular income for investors. These funds typically invest in assets that pay dividends or interest, such as bonds, dividend-paying stocks, or real estate investment trusts. The goal is to provide a steady stream of income, which can be beneficial for investors seeking regular payouts to supplement their earnings or cover expenses. Income funds may be suitable for investors who prioritize income generation, such as retirees or those seeking passive income. Second, fee checkup. Every picnic has a cost, and managed funds have fees too. These are like picnic basket rental fees called expense ratios. Compare different funds and choose one with lower fees to keep more of your hard-earned cash. Third, past performance peep. While past performance isn't a crystal ball, it can offer some insight into the fund's historical performance. Think of it like peeking at the leftover picnic treats from previous outings. It can give you a sense of the variety and consistency you might expect. Now that you've considered your goals, fees, and past performance, let's explore another important aspect of managed funds. Beyond asset classes. Diversification within asset classes. While diversifying across different asset classes is important, it's equally important to diversify within each class. Imagine filling your picnic basket with fruits and vegetables, but only choosing apples and carrots. You wouldn't want to miss out on the variety and nutritional benefits of other options, right? The same applies to investments. Within the stock class, for example, instead of focusing on just a few tech companies, consider spreading your investment across different sectors like healthcare, consumer staples, and financials. This helps reduce your risk if a particular sector experiences a downturn. Now let's discuss the importance of maintaining balance in your portfolio. Rebalancing your portfolio. Remember, building a diversified portfolio is an ongoing process, not a one-time event. As market conditions and your life circumstances change, your risk tolerance and investment goals may evolve. It's crucial to periodically rebalance your portfolio to ensure your asset allocation remains aligned with your desired risk profile. Think of it like refreshing your picnic basket. If you've been enjoying mostly chips and cookies, it might be time to add some fresh fruits and vegetables to maintain a healthy balance. Rebalancing involves buying more of asset classes that have underperformed and selling some of those that have outperformed to bring your portfolio back to its target allocation. Conclusion. By following these steps and continuously monitoring and adjusting your portfolio, you can build a diversified foundation for long-term financial success. Remember, diversification is a journey, not a destination. It requires commitment, informed decision-making, and seeking professional guidance when needed. Thanks for joining us today. If you enjoyed this video, be sure to like and subscribe for more informative content on investing and personal finance.